Welcome back to the 1% Mind. In our last video, we officially entered phase 2 of our master sequence, financial psychology. Imagine you are sitting in a boardroom at 8 o'clock on a Thursday night. You are staring at a complex financial spreadsheet projected onto the wall, tracking a startup venture or a significant personal investment portfolio. The numbers on the screen are undeniably poor. The project is bleeding capital. Every metric, customer acquisition cost, retention rate, daily active users, is flashing red. An objective observer would look at that spreadsheet and instantly conclude the project is dead. They would tell you to cut your losses and pivot to a vehicle that actually generates a return. But you do not shut it down. Instead, a specific psychological mechanism activates. You look at the metrics, and instead of retreating, you feel a desperate urge to double down. You authorize the transfer, throwing pristine, high-value new capital directly into a failing venture. When businesses collapse, it is rarely due to a lack of intelligence. Total bankruptcy often occurs because the human ego refuses to process a mathematical loss. Today, we analyze the sunk cost trap. We will explore why brilliant professionals hold on to losing investments and stay in dead-end jobs. I'll show you the biological pressure to avoid defeat and provide the framework the elite use to ruthlessly sever their attachments. To protect the wealth you build, you must develop the psychological architecture to survive your own internal cognitive biases. In academic economics, a sunk cost is a cost that has already been incurred and cannot be recovered. It is money spent or time lived. Because it is permanently gone, economic logic dictates that a sunk cost should never influence a future decision. But we are biologically driven survival engines. When you invest time or money into a project, your brain wires your self-worth to that investment. You don't just see a business, you see an extension of your own reputation. This friction is cognitive dissonance, the psychological agony of holding two conflicting beliefs. You view yourself as a high performer, but you're staring at a spreadsheet that mathematically proves a mistake. To resolve this tension, the brain alters reality, generating a narrative to justify the failure as a temporary setback. To understand why the brain enforces this behavior, we look back to the savannah. In extreme scarcity, abandoning a hunt meant massive caloric expenditure was wasted. In the primal world, wasting energy was a precursor to starvation. Your neurochemistry evolved to view the abandonment of an investment as a threat to survival. Your brain aggressively punishes you for walking away empty-handed. The sunk cost fallacy functions as a biological defense mechanism to protect the ego from the pain of defeat. In a modern, highly leveraged financial landscape, this ancient instinct becomes a liability. This trap destroys more than just portfolios. It consumes decades of human potential. Consider a 26-year-old attorney who has invested 7 years and $200,000 into a law degree. 6 months into the job, they realize they despise the work. The hours are agonizing, and the day-to-day reality drains their soul. They are operating outside of their zone of genius. A rational actor would accept the expensive miscalculation, resign, and pivot their intelligence into an industry where they can actually thrive. But the sunk cost trap activates at 2 a.m. The attorney tells themselves they cannot quit because they've spent the money and years of study.
They feel they must stay to justify the investment. The flaw in this logic is that the 7 years and the capital are permanently gone. By refusing to accept the past cost, they pay for a mistake made at 22 with the rest of their entire adult life. Defending a past identity destroys future potential. It is the act of throwing good decades after bad decades. Consider an investor who puts $50,000 into a speculative tech stock. After 6 months of missed earnings and scandal, the stock price plummets by 60%. The $50,000 investment is now worth $20,000. The market has provided a clear data point. The investment failed. But the investor refuses to sell because realizing the loss makes the mistake permanent. They tell themselves it's only a paper loss. The 1% possess the ability to decouple their ego from the spreadsheet. They understand that the capital burned the exact second it was spent. The true advantage of the elite lies in understanding opportunity cost. Opportunity cost states that every asset you hold, every dollar and every hour, has an alternative value. The elite investor looks at the remaining $20,000 and asks, if I held this in cash right now, would I buy this failing stock today? If the answer is no, they realize that by funding a corpse, they are starving a unicorn. They are choosing not to deploy that capital into a high-growth opportunity. The true cost of a losing investment is the compound interest you are not earning by deploying that capital into a winner. To remove these biases, the elite implement the zero-based audit protocol every quarter. Step 1. The CEO replacement. Mentally fire yourself from your own life. Imagine you are no longer the owner of your business or the director of your portfolio. A new, ruthless CEO has just been hired. They have zero emotional attachment to your past effort or your parents' pride. They only care about one metric: future return on investment. Step 2. The liquidation question. Do not ask, should I sell this? Instead, ask, if I held this entirely in liquid cash, would I buy this exact position at today's price? If the answer is no, you are violating the laws of capital allocation. You must liquidate the position immediately to free the trapped capital. Step 3. The autopsy and the pivot. The 99% view failure as an indictment of their character. The 1% view a financial loss as highly concentrated tuition. When an elite performer cuts a project, they conduct an objective autopsy. They extract strategic lessons from the failure and use that intelligence to pivot. This transmutes lost capital into proprietary market intelligence. They don't just bounce back, they use the momentum of the failure to scale faster in a new direction. The elite advantage relies on rapid recognition. When a project fails, they sever the limb before the infection spreads. Your past is dead, and the capital is gone. The only thing that matters is the highest leverage deployment of the resources you possess right now. In video 13, we examine loss aversion and the neuroscience of financial fear. I will show you why the biological fear of risk keeps the middle class paralyzed in safe investments. If this video gave you the psychological permission to walk away from a failing project, hit the like button. Subscribe to the 1% Mind and share this with a colleague who is refusing to pivot. Stop funding your past. Start architecting your future. I will see you in the next video.